Iaccino of TraderOutlook.com, and Charles Campbell's not from Chicago, and yet still out with the Bernanke, right? So maybe he's from Chicago, Bob, but I'm trying to get a feel for some of this stuff. That's neither here nor there.
You can tell from his accent, Joe, if he's from Chicago. Right?
Yeah, you can. You can tell from the way he says Bernanke. So what?
Exactly.
So we got 8 out of 10 days now with I guess as soon as it looked like we weren't going to have the core actually come through the earth to our side of the world, the market started going higher, right?
Yeah, and they don't really show any signs of stopping. Obviously, there's always a pause at the end of month, end of quarter. There's always a pause just before non-farm payrolls, especially with, as you said, the 8 days preceding were all buyers. It was nothing but buyers. You'll see some of those people cover as we go into the most important number of any economic month, the non-farm payrolls number tomorrow. So you'll see it pause a little bit, but there's really nothing in the near term, in my opinion, that says the market's going to go lower in terms of the S&P. I just think it's got another $10 to $20 before there's any concern. I'm concerned about it over the medium term, but not in the short at all.
So given the last 3 months, I would never say what's going to determine what stock price movement. I wouldn't. I'm afraid to I'm afraid to conjure up something else with what we've seen. But what will the likely impetus be, do you think? Will it be earnings? Will it be the Fed? Will it be QE2? Will it be the bond market? Will it be the dollar? Will it be Europe? All of the above?
I think the dollar and the earnings are the two things. I mean, earnings are going to continue to look better. Companies continue to sort of manage estimates of their earnings, and they continue to beat, and I think they will continue to beat, especially with the weaker dollar. There doesn't seem to be any dollar strength in sight. And I've said in the past on your show that I'll believe in the recovery fully when I see stronger dollar and stronger stock prices. But that doesn't mean that stocks aren't going to go up with all this easy money flowing, with tightening going across the globe, expected in the ECB next week, happening in Taiwan this morning. You're seeing global tightening. You're not seeing that here. So you're still seeing free money, and this is where the money is going to flow to until that changes.
Kind of interesting that we had that nice January and February, and then all bets were off. We gave it all back. Now we're almost back to what was the high on the Dow was February. What was that? February 18th, I think. 12.
Yeah, somewhere in that range.
12,391.
12 to 16.
Yeah, so we're 41 points from a high for the year.
And I really don't see any way, again, that we don't test that unless there's just an absolutely destructive number on Friday. You will see a little bit of a rest. You will see a little bit of a sideways move. But once Monday morning comes around, the dust has settled from the non-farm payrolls number. As long as that doesn't shock to the negative, still expected for the rate to stay the same, expected for another 190 to 200,000 jobs to be added. The ADP survey showed that that's probably going to happen. So I just don't see any way that we don't test that high. Having said that, if we can't close above it, you start to get sellers taking profits and watching for the next move. But there's issues for the market in terms of U.S. debt and the way it's viewed across the globe for Q3 and Q4, but I just don't see that coming in the short term at all.
So if someone had told you, all right, and they did, they said like about a month and a half ago, market's ready for a correction, probably be one of those 5 to 7 to 10% corrections. What's going to cause it? If they had played out the events between Libya and everything that's happening with the tsunami and everything else, to get a 7% correction and all of a sudden be back to where we were, that's just so strange. But it's one for the history books, I think.
Well, it's definitely one to worry about, again, when you get to Q3. That correction, to me, wasn't enough. I was looking for somewhere in the range of 15 to 20%, regardless of what caused it, just because of the strength in the market since August and really nothing else. I mean, this has been an unbelievable move. It's been an unbelievable quarter, best in the decade, obviously. And at times, as a trader, you start to think, I just can't buy it up here. I just can't buy it up here. The last move always comes after you've said, I just can't buy it up here, and it keeps going up, so you buy it up here, and then you're the last one to get in. So, and that's what's going to happen at the highs. When we get up there, that's what's going to happen. And then we'll see if there's events that can sustain it, like a QE3. I don't think that's going to happen. But, again, short term, you just have to buy these dips if they show up at all.
All right, great. Thanks, Bob.